Have you ever noticed how the price of something can be different depending on where you buy it? A bottle of water at an airport versus a grocery store, for example. That simple price difference is the core idea behind a surprisingly common and potentially profitable strategy called arbitrage. Arbitrage. It sounds complicated, maybe even a little Wall Street-y, but the concept itself is quite straightforward. At its most basic, arbitrage is the simultaneous purchase and sale of an asset in different markets to profit from a tiny price difference. Think of it as exploiting a temporary inefficiency in the market. Now you might be thinking, okay, so I buy low and sell high, that's just investing. And you're partly right. But arbitrage isn't about predicting future price movements. It's about capitalizing on current price discrepancies. The profit isn't made by waiting for something to increase in value, but by instantly exploiting a difference that already exists. Let's look at a really simple example. Imagine you're in New York and see a baseball card selling for $10. Simultaneously, your friend in Los Angeles texts you and says the exact same card is selling for $15. If you could instantly buy the card in New York for $10 and sell it to your friend in Los Angeles for $15, you'd make a $5 profit, minus any transaction costs, of course. That's arbitrage in its purest form. Now, baseball cards are a fun example, but in the real world, arbitrage happens constantly with a huge range of assets. It's particularly prevalent in financial markets, stocks, bonds, currencies, commodities, and even cryptocurrencies. Let's say a company's stock is trading on two different exchanges, the New York Stock Exchange and the Nasdaq. For a split second, due to technical glitches or differing demand, the price on the NYSE might be $50.05, while on the Nasdaq it's $50. An arbitrager, typically using automated trading programs, would instantly buy the stock on the Nasdaq and simultaneously sell it on the NYSE, pocketing the 5 cents difference per share. It doesn't sound like much, right? But these trades happen millions of times a day, and when multiplied by large volumes, those tiny differences add up to substantial profits. Why does this happen? Why don't people just instantly correct these price differences? Several factors contribute. Information doesn't travel instantaneously. There are delays in data feeds, and different exchanges operate with slightly different rules and speeds. Transaction costs, like brokerage fees and exchange fees, can sometimes eat into the potential profit, making it not worth executing. And as mentioned, automated trading programs are often the fastest to identify and capitalize on these opportunities. For a U.S. audience, understanding arbitrage is increasingly relevant. The rise of cryptocurrency trading has created a massive new landscape for arbitrage opportunities. Different crypto exchanges often have varying prices for the same coin. This is due to differences in supply, demand, and exchange rates. Savvy traders can exploit these differences to profit. Another example relevant to the U.S. market is in the foreign exchange, or Forex market. The exchange rate between the U.S. dollar and other currencies fluctuates constantly. An arbitrager might find a slight difference in the USD/EUR exchange rate between two different banks or trading platforms. They could buy dollars with euros at the lower rate on one platform and simultaneously sell those dollars for euros at the higher rate on another. Now let's be clear, arbitrage isn't easy money. It's a highly competitive field dominated by sophisticated traders and firms with powerful computers and lightning-fast connections. The margins are often incredibly thin, and the opportunities disappear quickly. It requires significant capital, specialized knowledge, and a willingness to take on risk. There are different types of arbitrage. We've discussed simple price arbitrage, but there's also triangular arbitrage, which involves exploiting price differences between three different currencies. There's also covered interest arbitrage, which involves exploiting interest rate differentials between two countries while hedging against exchange rate risk. These are more complex strategies requiring a deeper understanding of financial instruments and markets. The key takeaway is this: Arbitrage is a fundamental concept in efficient markets. It helps to eliminate price discrepancies and ensures that assets are priced consistently across different exchanges and platforms. While profiting from arbitrage requires significant skill and resources, understanding the underlying principle is essential for anyone involved in trading or investing. It's about finding and capitalizing on temporary inefficiencies, not predicting the future. It's a constant search for a tiny edge in a complex and ever-changing market. In short, arbitrage is the simultaneous buying and selling of an asset in different markets to profit from a price difference. It's a fast-paced, competitive strategy relying on efficiency and speed, prevalent in financial and cryptocurrency markets. It's a key driver of market efficiency, ensuring prices are consistent across platforms. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.